Hello and welcome back to Principles of Accounting 2. I'm your host, Dr. B. Today we're going to be covering budgeting. Before we jump into budgeting, I do want to quickly identify where we are, where we're heading. Uh, Last week you completed the midterm exam. Most of you did very well with the midterm exam. Uh, there were a few students there were two students who actually did not take the exam, and so those students are failing the course currently. So, which leads me to my next point. Make sure you do everything in the course. Don't miss anything. Everything is worth something. As you know, each assignment's worth 5% of your total grade. The midterm exam was worth 10% of your total grade. The final exam is worth 20% of your total grade. So where are we currently? Week 5. Today we're going to cover chapters 22 and 23. Next week we'll cover chapters 24 and 25. There inlays a small, possibly small issue. After next week, there are still two more chapters to go. However, these two chapters, or three chapters technically, chapters 26, 27, and 28 will not be graded toward the final exam. Reason being is because the textbook publisher updated the version of the book, the current version that you all are using.
Which one? Which ones were going to be graded?
So chapters 26, 27, and 28 will not count toward the grade on the final exam.
All right, just
So
checking.
don't worry so much about 26, 27, 28. Most of you have a textbook. It only goes up to chapter 26. That's totally fine. Okay. What happened is the textbook publisher broke out a couple of different chapters and they made it into two chapters. It's all the same content. So about um, don't worry about that. What I will, however, still ask you to do is to complete Chapter 26 quiz, Chapter 27 homework, Chapter 28 discussion board. So
Quiz,
definitely,
homework, and discussion.
what was that, Drew?
All right, 26, 20.
26 quiz, 27 homework, 28 discussion board.
All right, just checking.
Yeah, thank you, sir. So yes, please make sure that you still complete those assignments, but don't worry so much about the content showing up on the final exam. Uh, we'll talk more about that when we get closer. I just want to give you a heads up as to where we're heading.
All right.
Okay, so let's jump into today's content. We're going to talk about budgeting right now, and then after that we'll jump into the next chapter, 22. So the budgeting chapter that we're about to cover, there is a quiz that is due this Sunday night for the budgeting chapter. Chapter 23, I believe it's a homework assignment. So let's go ahead and jump into chapter 22, budgeting.
I did.
Okay, so budgeting. Budgeting, in my opinion, one of the most important things you can do both personally and professionally. Budgeting tells us how much we should be spending and what we should be spending it on. Budgeting gives us permission to spend. It gives us guidance on what to spend money on. Every organization, no matter how large or how small, should have a budget. Budgeting is a very important concept. It tells us how much to spend and what to spend it on. For example, you have a budget for rent or for your mortgage. That budget is the amount that is owed each month. If you add up the 12 months in a year, that is your annual budget for that line item. And you could have other budgets, a budget for electricity, a budget for other utilities, a budget for internet, a budget for um, food, a budget for entertainment, so forth and so on. That's your personal budget. The same concept applies in business. We have budgets for the rent, we have budgets for how much we're going to spend on raw materials, direct labor, factory overhead. We got budgets for pretty much everything. So as we go through this concept, we'll talk about it from manufacturing, just as we always do. So why do we establish budgets? Budgets help us to establish goals. They help us to execute our plans, and they help us to compare our goals to our actual performance. So, what does all of this mean? So, as we spend money throughout the year uh, on, toward our goals, on what we need to spend money on, we can go back and compare what we actually have spent to our budget. And that gives us an idea if we're overspending or underspending. Throughout this budgeting experience, management has a couple of factors that they need to follow. We call this these are called management functions. Okay. The first one is planning. A plan helps the organization to plan on what they're going to spend money on. That's the planning part. Okay, what happens here is management gets together and they say, all right, in order to grow the business, we need to identify what we plan to spend money on. Okay, uh, so part of the management's function here is planning. Second one is called directing. As we go through the year, management directs the money that is being spent. They tell it what to do, right? And in this process, we have what's called a responsibility center. A responsibility center is very similar to a department or to a goal. And this responsibility center is led by management, and management tells responsibility center how to spend their budget. Think of responsibility center as a department, if you will. And each department has a manager. Each manager is responsible for directing the budget through the responsibility center. The third management function is called controlling. We control the budget, we control the performance by comparing what we actually spend in comparison to the budget. Okay, so for example, let's say I budgeted $100 a month for utilities for electric. One month I might come in at $90, at the end of the month. Another month I might come in at $110. Another month I might come in around $100. Um, what we can do based off of that information is we can adjust the budget in the future based on the actual performance. This is through a process of control. There are a lot of human behaviors that go into money. I know it's not that surprising. Human behavior affects how we budget. What do I mean by that? Sometimes I feel like I spend too much. I'm always exceeding my budget. That means my budget is too loose. too easy to achieve my budget goals. Sometimes I feel like I don't have enough room to pivot. I don't have enough room to adjust. That means my budget is set too tightly, makes it difficult to achieve my goals. Sometimes uh, I don't like the budget. I have a conflict with the budget. So these are all human behaviors, and they're potential problems that arise in the budgeting. If we set the budget too tight, we can't achieve the goals. If we set it too loose, the goals are too easy to obtain, and that means that I set my bar too low. And sometimes I don't agree with the budget, and there's going to be conflict. So these are all human behaviors. If I view the budget as being unrealistic or unachievable, this will have a negative impact on the company's ability to achieve its goals. In other words, it'll demotivate employees to attain goals. If an employee knows that the goal is not attainable, the employee will feel demotivated and will not want to try to achieve that goal. The same concept applies in budgeting. If I set the budget too high or too tightly, it will be difficult for us to achieve that goal, and thus will cause conflict. Sometimes, if the budget is set too loosely or too easy to attain, it can also have an impact on employee morale or demotivation. If it's too easy to attain it, I become demotivated because it's too easy, right? Uh, Oftentimes, when we build our budget, put in a little bit of padding, a little bit of slack, right? Make it easy to attain sometimes. So we call this budgetary slack. Yeah, it's where we pad the budget. Give ourselves enough cushion, enough breathing room. This is nice, but it 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 becomes a disincentive to attain the goal. It gives us too much room to work with, and that can be a disincentive to attain goals. And sometimes employees and management have their own interest in mind, and those interests do not align with the company's goals, and this causes what we call a goal conflict. Hopefully you learned a little bit about that in your Intro to Business course. When we look at budgeting systems, we typically budget for 12 months, okay? We typically budget for about 12 months. Some companies will budget their 12 months on the calendar year. Other companies will use what we call a fiscal year. We learned about this back in Accounting 201, hopefully you remember. Fiscal year, it can be any 12 months, but it has to be consecutive 12 months. So for example, when I had my own company, my fiscal year ran from April 1st to March 31st. Okay? That was my fiscal year. The calendar year, as you know, runs from January 1 to December 31. Some companies follow the calendar year, some companies have their own fiscal year. Correct me if I'm wrong, I think the government budget October 1 through September 30th. So that's their fiscal year. That's how their fiscal year operates. For control purposes, sometimes we separate these out into quarters, months, or weeks. even days for some companies. The idea behind it is that we can set budgets based on quarters or months. We typically do monthly. But as we plan forward budgeting, we call this continuous budgeting. What does it mean? We plan 12 months into the future continuously. So, for example, right now we're in April, okay? I have already budgeted out, right now we're in April 2021. I have already budgeted out April 2022. Right now, I need to be budgeting for May 2022. And then when we move into May, I should be budgeting for June 2022. When we move into June, I should be budgeting for July 2022. In other words, we maintain a continuous 12-month projection into the future. What that does is it helps me to understand, based off of trends, how much to plan for that next year. For example, if I realize that the cost of electricity has risen by 3% in the month of April compared to last year, April, I want to make sure that I budget an additional 3% for April of 2022. That's what that process helps me to do. And this is what it looks like graphically. We see that once February 21 had finished, we added February 22 to the next year. March 21, March 22, April 21, April 22. The point is we have a continuous 12 months planned in the future. That process is continuous, so we do it on a regular basis. We also develop budgets for an entire year. We usually start that process several months in advance. And everyone who is in charge of management is responsible for their respective budgets. I'm going to give you an example from my hotel days when I was managing a very large hotel in New York. We typically did our budget if we followed the calendar year. So our fiscal year started January 1st and ended December 31st. That was our fiscal budget. Followed the calendar year. So what we would do typically is we would start the budgeting process in August. Okay, that's several months in advance of the next fiscal year. The reason why we did that is because there are a lot of people involved in the budgeting process, what we call a budget committee. That committee is made up of our department managers at the hotel. I have the engineering department, the front of house department, back of house department, banquets. I had housekeeping, rooms division. I had, let's see, I had venues. I had restaurant. So all of these different departments, right? And so each department had a manager or a director. And those managers and directors would create the budgets for each department, okay? And after they had created their budgets for their respective departments, they would send those budgets, individual budgets for each department to the accounting department, that was me. And I would take all of those individual budgets and create what we call the master budget. And the master budget was for the entire hotel, okay? And that was how we did it. There are a couple of ways of developing budget estimates. One of these ways is called the zero-based budget, where everything starts at zero. That's why I call it zero-based. What this does is it requires managers to um, budget based off of zero sales. And so what that does is a zero-based budget allows for the budget to be established as if the company's brand new. It's being started for the very first time. So Alex has a very good question. Alex is a hospitality major, just like some of you are in the course. Question is, which department had the highest budget? Great question, Alex. Typically, the highest budget in the hotel, that was usually events, usually had the highest budget for our hotel. Reason being is we had a lot of catering, for a lot of weddings, a lot of conferences, a lot of large groups would stay at the hotel, and they would reserve for event space, and the events typically had the largest budget because they spent a lot on food and beverage. So food and beverage overall was probably typically the highest budget department was food and beverage. Uh, they they made up about 40% of the budget was food and beverage. Yeah, at any time, Alex. Yeah, and housekeeping was usually about 20%. Food and beverage was about 40%. Um, Rooms division was usually another 20%. Um, Maintenance department, engineering, they usually made up about 10 to 20%, depending on the year. Um, Sales department had 10%. Yeah, it was fun. It's a fun business, real fun business to be in. So yeah, from an accounting perspective, it's very entertaining. So with a zero-based budget approach, we start with everything at zero, and then for that next year, we get actual data, and then we compare it to the expected results, and that helps us to plan for the future. So if you have a brand new business, let's say you have a catering business and it's a brand new business, and you're like, oh man, I have no idea how to do a budget, start with zero, okay? After your first year of operations, now you have some data, and you use that data to build your budget for the following year. So start with you estimate your sales, estimate your operation expenses as if it was zero. There are two primary types of budgets. One's called a static budget. The other one is called a dynamic budget. The word static means it doesn't change. Okay, it doesn't change over time. Static remains the same. Static. With a static budget, what it means is we have a set amount, okay, and we use that set amount for each function of the business: purchasing, engineering, accounting. Uh, Typically, this is done with government entities and some service businesses. We use a static budget. So in other words, we set the budget for each line item on your income statement. We set the budget for each line item on the income statement, and that budget does not change regardless of the level of activity. Okay? So if I have a really up month, like I got a lot of revenue coming in, I can't spend more than what the budget says. Or if I have a really down month on revenue, I can spend less than what the budget says, but I still cannot spend more than the budget. Okay? So that is a disadvantage of the static budget because it cannot change regardless of level of activity. That's why I personally do not like a static budget. Here's an example of a static budget. In this example, we have a set budget for the year, $40,000 direct labor, $5,000 electric, utility, $15,000 for supervisor salaries, giving us a total department budget for the year of $60,000. This is for the assembly department of a company. Okay? Again, the problem with a static budget is it doesn't change over time. So that's problematic. You know, if this department all of a sudden I get this massive electric bill sometime throughout the year, that just ate away at that $5,000. So that runs a risk of going over the $5,000 budget. When that happens, we have a budget deficit, and then we have to do all this justification and all this jazz. So that's why static budgets, they're not very good, in my opinion. In my opinion, okay? Government entities, you know, government departments of the federal government or the state government or the local government, they all have budgets, okay? They all have static budgets. They say, here's your budget for your department, you know, set up your department budget, don't go over it, right? You can't go over it, it's static. And it doesn't change regardless of activity. So that's a problem with static budgets. Flexible budgets, on the other hand, I like flexible budgets because we can change the budget based off of activity levels. It makes it a little bit more dynamic. It's also called a dynamic budget. Flexible means dynamic. Same term, interchangeable. Richard, did you have a question?
Yes, I was actually typing it in the chat box, but what would you recommend to startups with seed funding, limited budgets when it comes to budgeting?
I'm sorry, can you repeat the question?
Of course, I said, what would you recommend to startups with seed funding, limited budgets?
Yep, seed funding, great question. So if the business is brand new, meaning we don't have a year's worth of operating data, my recommendation is to start at what we call a zero-based budget. That is the expectation that we're going to estimate our total sales, we're going to estimate our total expenses, and it's zero-based, meaning we start at zero for each line item, but you have estimates, okay, for your revenues and your expenses. So ultimately, the zero-based budget is going to be the best option for a startup company that is using seed money as revenue. That is one option. I would use that in conjunction with a flexible budget. Startups need to be very flexible. It's important that they have the ability to pivot where they see fit. And that's why flexible budgets are, well, one of the reasons why flexible budgets are way better than static. Does that help to answer your question, Richard?
Yes, absolutely. Thank you.
You're welcome. Alex, go ahead.
Yeah, I had a quick question. Is it possible, say like, okay, just to start off, the shepherd knows their sheep. And is it possible that sometimes the shepherd determines that based on the mentality of the sheep, oh, we're going to have a flexible budget. Okay, with this individual, with this department, we're going to have a fixed budget. I mean, is that possible?
Yes, it is. It's possible to have both. Absolutely. So typically what happens there, Alex, is the accounting department or other support services like human resources, accounting, um, maintenance, those support services for the business, they typically do have a static budget. They usually have a static budget for support services of the business. Human resources, accounting, um, other support departments like that, administration. Those are support services. They typically have a static budget. For other departments like the fabrication department, the assembly department, the uh, customer interfacing departments like sales, they typically have a flexible budget because their expenses are based on the level of activity.
Okay, so considering, okay, going back to your example in reference to the hospitality area,
Yep.
the person who had the department that had the highest revenue or incoming or cash flow, they would probably have a more flexible budget.
Yeah, absolutely. Yep. That's pretty common, Alex. So at the hotel, my department, the accounting department, we had a static budget. It was fixed. All it did is it covered the office salaries and it covered um, office expenses. That was it. It's a fixed budget for the accounting department. For the sales department or for the food and beverage department or for even for house the rooms division, which included housekeeping and the front desk, those departments typically had a flexible budget because their revenue and their revenue would increase or decrease monthly, and that would mean that their expenses would have to increase or decrease based off of the changes in the revenue.
Awesome.
Yeah. Great question. Great question. Very cool. Yeah, it's fun. I think it's fun. A lot of people think it's fun. All right. How do we create a flexible budget? There's 3 steps. First one, identify relevant activity levels. Activity levels, as you know, is based, thinking about activity-based costing. Activity levels are based on units, machine hours, labor hours, some other activity base. So that's step one, identify relevant activity levels. Step two, identify fixed and variable cost components. We know that there's going to be fixed costs. We know there's going to be variable costs. Step three, prepare the budget for each activity level by multiplying the variable cost per unit by the activity level and then adding in the fixed cost. So here's how it looks. Step one, identify the activity level. So step one, we have units of production. That is our activity level. And we have 3 different levels. Think of it like low, medium, high. Okay. During the year, we might at the low end produce 8,000 units. Average about 9,000 units. At the high end, we might produce 10,000 units. That's usually based off of capacity, typically, when we do this type of planning for manufacturers. Step two, identify variable and fixed cost components. So variable costs, we have direct labor, we have utilities, those are our variable costs. Our fixed costs, we have, again, utilities and supervisor salaries. Now I could hear you already, you're saying, well, Dr. B, I see that we have electric, utility, and both variable and fixed costs. How did that happen? You might be asking. Well, think about the earlier example we gave when we rented a piece of machinery we said it was a mixed cost. Remember, if you remember that example, we had a piece of machinery that we were leasing or renting. It had a base cost of $15,000 a year. And if we went over 10,000 machine hours, we had to pay an additional dollar per hour, right? And the same concept applies to electricity. We have base electricity, that's the minimum expense for electricity that you have to pay, right? Plus kilowatt hours, right? So kilowatt hours is, of course, the variable cost based off of the number of hours used. So that's why you see electric as both variable and fixed cost. And of course, under fixed cost, we also have supervisor salaries. We add our variable cost to get total variable cost, add your total fixed cost to get total fixed cost. And we add total variable cost, total fixed cost to get total department costs. Step 3, you can see we have the range, right? It's irrelevant. We call that a relevant range. We'll talk more about that. With flexible budgets, they change based off of activity, so therefore they are the most useful to use. This is a nice visual comparison between static and fixed. We see with the static budget, it remains the same regardless of the level of activity. We see with the flexible budget, it changes with the level of activity. We compare at the end of each fiscal year or month, however often you want to do it, we compare the actual results to the budget. We can see with the static budget, our actual performance, we budgeted 60,000, we came in at 70,800. That means we're over our budget by 10,800. Oh, over budget. Oh no. I don't like being over budget. Over budget's not good. Okay. That will get you in a lot of trouble in business, being over budget. That means your expenses were too high. Again, that's one of the problems with a static budget. It remains the same over time regardless of the activity. With a flexible budget, I can do 8,000 units, 9,000 units, 10,000 units. This represents the change in the level of activity. Okay. Based on the level of activity, at the low end, I budgeted 60,000, medium 65,500. At the high end, I budgeted 71,000. The budget changes with the level of activity. My actual result, 70,800. That means I came in under budget by $200. That's really good. That's what you want to happen. Or you want to be close to the actual. The actual should be always close to the budget, as close as humanly possible anyway. That means you did well. But this kind of shows you that comparison, right? Earlier I had mentioned in my example of the hotel business that each department has their own budget. What we do while we're preparing the budget is we collect all of the department budgets together and prepare what we call a master budget. The master budget is for the entire hotel. So looking at this, we prepare on a yearly basis. That's that thing that we start in September or August. That's usually not ready. It's not for that following January. We do it. We start early on because we prepare it annually, and there's a lot of people involved. It is comprised of operating and financial budgets over for the 12 months. The operating budgets are based on our income statement, and our financial budgets are based on our balance sheet. So what this tells us is that as we prepare our budgets, we include everything, right, in the company. So when you think about your income statement, we know we have sales minus cost of goods sold equals gross profit minus selling administrative expenses equals net income. Okay. So when you think about your income statement, each line item on your income statement needs to be budgeted. We call that an operating budget because the income statement is derived from day-to-day business operations. So all of the things on your income statement together creates the budgeted income statement. We also have financial budgets. Of course, we need to have a budget for our cash and our property, plant, and equipment expenditures, also known as capital expenditures. And those two budgets together equal our balance sheet budget. Well, how does it all look operationally? Our sales, most of our budgets are derived from sales. They're derived from sales or projected sales. So earlier, Richard had asked the question, what if we have a new company that's using seed money? We don't, we haven't quite started operations, or maybe we're just starting operations. How do we budget? I had said, use the zero-based budget. Well, what does that mean exactly? Zero-based budget takes into consideration the projected sales. Okay, projected sales. So if Richard's like, oh, we're selling these new products and we're trying to get them out to the marketplace, I really don't know how much we're going to sell each month or throughout the year. That's totally understandable. But if you can at least estimate the number of units you plan to sell throughout the year or the amount of services you plan to sell throughout the year, whatever it is, you want to include that in your sales budget, okay? That sales budget will then inform, if it's a manufacturing business, it will inform the production budget. Production budget means how many units I plan to make. And as you know, the cost of a single unit is derived from direct materials, direct labor, factory overhead. Direct materials, direct labor, factory overhead, they have their own budgets. That's derived from the production budget. When all of the production is completed, and then we plan to sell each unit that we produce, all of that equates to the cost of goods sold budget. And the cost of goods sold budget translates onto the budgeted income statement. And as you know, with sales, there are selling administrative expenses. Remember, those are called period costs. And those period costs get also budgeted, and they go onto our budgeted income statement. The sales budget kind of guides all budgeting, especially for a new company like Richard was talking about. So the sales budget is where you want to start. You start by estimating the quantity times the sales price. Right? And that will help to derive your sales budget. If you have previous year's sales data, you start with your previous year's sales data. If you don't, you start at zero. Okay? And you estimate. We factor this based on planned advertising and promotion, projected sales price changes, expected industry general economic conditions. What this tells us is each year or every so many months we adjust our sales budget based off of these types of changes. If Richard says, hey, I just got the company off the ground, I'm going to run a TV advertisement that's going to cost me $200,000. And based off of that TV advertisement, I plan to generate an additional $60,000 in sales. Then we would make that adjustment for the additional $60,000 in sales, and we would also adjust our expense by $200,000. And so those types of changes will help us to derive our budget. How do we budget for revenue? You take your expected sales volume, in other words, how many units you plan to sell, times the expected unit sales price for each unit. Here's an example. We have a company here that sells wallets and handbags. Wallets and handbags, we have two different regions or divisions. We have the Eastern Division and the Western Division. Wallets sell for $12 a piece, handbags sell for $25 a piece. And here's their sales volume: 287,000 Eastern for wallets, 156,400 Eastern for handbags. In the West, we got 241,000 wallets, 123,600 handbags. So how do we figure out the total sales budget for each? Well, in the East, for wallets, we said we're going to sell 287,000 wallets at $12 a piece. That's 3,444,000 sales dollars for the Eastern wallets. 241,000 times $12 is 2,892,000 for the West. You add your East and West together to get a total of 6,336,000 budgeted for wallets for the year. And you do the same process for handbags. Handbags total 7 million for the year. You add your total for each product. So total for wallets, total for handbags, giving us $13,336,000 of planned, estimated, budgeted total revenue for sales for the year. Now that we know what our sales are, or what we plan our sales to be, we can create the production budget. Production budget is how much we plan to make to meet our sales goal and desired ending inventory levels. To create your sales budget in terms of units, we take the expected units to be sold. We find our desired units in ending inventory, how much we want to have at the end of the year, minus our estimated units at the beginning of the year, equals the total units to be produced. So looking at our example, our estimated inventory in the beginning of the year is 88,000 wallets and 48,000 handbags. At the end of the year, I want to have 80,000 wallets and 60,000 handbags in my inventory. So here's what we do. You take your expected units to be sold. We're going to sell 528,000 wallets. We're going to sell 280,000 handbags. Okay, plus our desired ending inventory, 80,000 wallets, 60,000 handbags, equals our total units available, 608,000 wallets, 340,000 handbags, minus our estimated beginning inventory, how much we're going to start the year with, 88,000, 48,000, equals total units to be produced. How many wallets and handbags I need to make in order to meet my sales goals and my ending inventory goal. What that information tells us is how much direct materials, direct labor, factory overhead I need to budget for based off of levels of planned production. So we create a direct materials budget. This tells us how much materials we need to purchase, quantity of materials we need to purchase to meet our sales goals and our ending inventory goals. To figure out how much we need to purchase, there's 3 steps. Step 1, budget for direct material. We take our budgeted production volume, that's how much we plan to make, times the direct materials quantity expected per unit, how much quantity I need to make per unit, That's step one. Step two, we budget for beginning and ending inventories. So we take how much materials we need for production. We got that from step one. Plus desired ending inventory minus estimated beginning inventory equals direct material quantity to be purchased. And then step three, we find the budgeted direct materials to be purchased. How do we find this? We take direct materials quantity to be purchased, how much we need to purchase, right? Times the unit price at which we'll purchase it at. So, looking at our example for making wallets and handbags, each wallet requires 0.30 square yards of leather material. Each wallet requires 1/10 of a square yard of lining. Each handbag requires 1¼ square yards of leather and 1/2 a square yard for lining. We have our inventory amount that is estimated for the beginning and the end of the year. The leather, 18,000 square yards. Lining, 15,000 square yards beginning of the year. End of the year, we want to end with 20,000 square yards of leather and 12,000 square yards of lining. The estimated price, $4.50 for leather per square yard and $1.20 for lining. So how do we do it? Step one, we identify the quantities that we plan to make. Step two, we identify the beginning and ending inventory balances. Step three, we identify how much each direct material is going to cost for the budget, right? The budget the direct materials cost. So once we find out how much we need to purchase, 523,000 square yards for leather, 195,000 square yards for lining, multiply that by the purchase price, equals the total amount of materials for each direct material, and you add each direct material together. For a total of $2,587,500 is our direct materials budget. It's very similar process to what we learned before. So we have a budget for direct materials. Now you got to budget your direct labor. It's based off of how many hours are needed for the production department. How do we find the labor? Well, there's two steps. First is we've got to figure out how many hours are going to be used based off of the number of units we're producing. So your number of units you plan to produce, also known as the budgeted production volume, times the direct material quantity expected per unit. That will give you your budgeted labor hours. That tells you how many hours you're going to need. Step two, how much is the cost? You take your direct labor hours for production that you got from step one times the hourly rate. That will get you your direct labor cost. So looking at our example, for wallets, cutting department budgeted 0.1 hours. Sewing department is 0.25 hours for wallets. For handbags, 0.15 hours for cutting department, 0.4 hours for the sewing department for handbags. The cutting department hourly rate is $12. Sewing department hourly rate is $15. In step one, we find the number of units to be produced, okay? and allocate it based on the number of hours for each area. Step 2, we take the total, multiply that by the hourly rate to get the total direct labor cost. And of course, you add up your direct labor costs for each department to get your total direct labor cost. In our example, 4,851,600. And of course, we found direct labor, direct materials. Now we got to do direct factory overhead. Factory overhead, as you know, is an estimate based off of debtor support for the budget. Factory overhead can be based on things like department schedules, and they're typically evaluated by management each year. Here's our factory overhead for the year. We have indirect factory wages. We have supervisor salaries, utilities, depreciation for property, plant, and equipment, indirect materials, maintenance, insurance, and property tax, giving us total factory overhead cost $2,089,880. Good news is with the factory overhead from that perspective, there's not a whole lot of factoring that needs to be involved. Then we find our cost of goods sold budget. As you know, cost of goods sold includes direct materials, direct labor, factory overhead, work in process, conversion costs to equally get to our finished goods. Using our example, we have direct materials, work in process, finished goods. Work in process, direct materials, finished goods. Okay, so we have finished goods inventory, work in process inventory, and finished goods inventory for the beginnings of the year. We have it for the end of the year. Cost of goods manufactured, cost of finished goods available for sale, based off of beginning inventory plus your cost of goods manufactured gives you cost of goods available for sale, minus what you sold, right, gives you cost of goods sold. And then, of course, you got a budget, selling administrative expenses. These are period expenses that simply go onto the expense lines. Sales, salaries, advertising, travel expenses, those are all selling expenses. And you have your administrative expenses, officer salaries, office rent, office supplies, miscellaneous, administrative. Total selling plus total administrative equals total selling administrative expenses. Those are period expenses. They go directly onto your income statement. And to find the total budgeted income statement, you have your sales revenue, budgeted sales revenue, budgeted cost of goods sold revenue, or budgeted total cost of goods sold, your total budgeted selling administrative expenses, any other income, other expenses, and budgeted income tax. The budgets are summarized based on daily operating activities, and here is an example of what the budgeted income statement looks like. You all already know what an income statement looks like. It's just a matter of having the budgeted format. It's very, very similar to what you've seen before. Financial statements, earlier I had said we have a budgeted income statement. We also have a budgeted balance sheet. The budgeted balance sheet includes a budget for cash and a budget for capital expenditures. And this reflects the purchase or sale of property, plant, and equipment, and planned day-to-day operations, collection of payments, and from our customers, and the payment of our bills. cash inflow minus cash outflow equals net cash flow. You've heard me say that probably 100 times or so. That gives you cash budget. We estimate cash receipts, which is what we expect to collect from our customers. We expect to collect a certain percentage throughout the year. So, for example, in the month of January, I'm going to collect sales from last month and some sales from this month of January. In the month of February, I'll collect the rest of January and some of February. In the month of March, I'll collect what's left in February and collect some in March, so forth and so on. We estimate how much cash we'll be collecting from our customers on account. And that's how we estimate how much cash we'll be collecting for each respective month. Yeah, so it's relatively straightforward. How much we plan to pay out in cash, we estimate that based off of when our bills come in, typically any planned expenditures for property, plant, and equipment, depreciation that's planned, budgeted manufacturing costs. We obviously got to pay our suppliers. Any type of accounts payable last month versus this month. Works very similar with respect to the revenue that's coming in. Cash going out, we budget it the same way. It's based off of a schedule of payments that we make throughout the year. It's good to have an idea of what your cash might look like each month, right? What budgeted cash for the period. So the way we find the budgeted cash for the period, we take estimated cash receipts. That's how much we plan to get in from our customers based off of what we sold on account. Minus estimated cash payments. That's cash we're using to pay our bills. Equals the cash increase or decrease plus cash we started with at the beginning of the month. Plus cash at the end of the month minus our minimum cash balance equals any excess or deficiency. The excess means the additional, right? Deficiency means a decrease or loss of cash. Using our example, we have cash at the beginning of the month, $225,000. I'm sorry, for the quarter. Cash at the beginning of the quarter, $225,000. We expect to pay taxes at the end of March, quarterly taxes, $150,000. We expect to pay quarterly interest based on our loans, $22,500. We expect to earn interest on some of our investments, $24,500. We expect to purchase a piece of sewing equipment, $274,000. And we expect to incur selling administrative expenses, January, February, March. So how does it look? Cash coming in, okay. Cash coming in. Minus cash going out equals total cash. So total cash coming in minus all the cash going out equals the change in cash plus cash at the beginning of the month, plus cash balance at the end of the month, minus selling minimum cash balance. That's the amount of cash that you need to have in reserves, as we say, equals the excess or deficiency. That's how the cash budget is created. Capital expenditures, this is the purchase of property, plant, and equipment. Equipment needs to be changed out over time as it becomes worn out or obsolete. Purchase additional buildings to increase production. You know how it is. Property, plant, and equipment. Capital expenditures. Here's the thing with capital expenditures. These are typically done over time. We plan out capital expenditures 5 to 10 years into the future. Some of you might recall a story I told about my days at the hotel. I told you about the chiller at the hotel, right? Do you remember that story? Who remembers that story? Anyone remember the story I told about the chiller that broke at the hotel?
Remember?
Do you remember the story? No?
I've never heard that story.
You didn't hear that story? Okay, let me tell you the story.
Broke into a hotel.
Yeah, absolutely. So here's what happened. So one year I was at the hotel, doing my thing. I was the accountant for the hotel, and I'm at my desk, and the chief engineer comes up, and the chief engineer goes, "Hey B, we got a problem." So what's up? He goes, "Well, the chiller is about to stop working." I'm like, "Oh, that can't be good." I go, "What's a chiller?" I had no idea what a chiller was. He goes, "Well, think of it like a large air conditioning unit that keeps the entire building cold." So, okay, I understand what it is now. I go, "Okay, how much does a brand new chiller cost?" He goes, a chiller for a building our size. The building, by the way, is 21 floors, 30,000 square feet banquet space, another 100,000 square feet of swing space, 640 guest rooms. Okay, just give you an idea, and a full restaurant and bar, and it's your typical 3-star hotel. So it's a big building. It's the second largest hotel in New York State. So I said, okay. So how much does a new chiller cost? He goes, building our size, you're looking at it probably about maybe around 100 million, anywhere between 100 million to $300 million. I said, oh, okay. Well, that's a lot. I said, we don't have 100 million or $300 million in the bank. I said, how much is it going to cost us to repair this guy? Because I'm like, I don't know if we can afford a brand new chiller right now. How much is it going to cost to repair it? He goes, a repair job on this, you're looking at probably, 4 to 6 million. I said, oh, okay. I said, well, that's expensive. I said, do we have the money in our capital budget? A capital budget is money that we have set aside for improvements to the building. We do renovations to guest rooms, just like every hotel does. We do improvements to the building, the facade, the pool, the various maintenance stuff, the big stuff, right? Capital expenditures are for like the really big stuff. The assets, property, plant, equipment. A chiller is a piece of equipment. So I said, well, we might be able to spread out the cost of the chiller for about 5 to 10 years. And so what we did is we had to borrow some equity, spread out the cost of the chiller 5 to 10 years, and we ended up buying a new chiller because we ran out the alternatives, right? The proposals. Proposal A, do the repairs. Proposal B, purchase a new chiller. It ended up making sense to purchase a new chiller because I also asked the question, how long will the chiller last if we just repair this thing? He goes, oh, maybe another 5 years. I said, well, how long will a chiller, a brand new one, last? About 20 years. Makes sense, go with a new one. It's a larger cost up front, but we can spread it out through the capital expenditures. That's the idea behind it. And that was what happened to me at the hotel, and that's what gave me some experience with working with capital expenditures budget. It wasn't a very good experience, but it was something that was necessary. So for those of you in the hospitality business, I thought you might find that it to be an entertaining story. So let's look at our example. This is our company. We're making handbags and wallets. We have machinery for the sewing and cutting department and some office equipment. This is our capital expenditures, and this is what we plan to do for 5 years for purchase of new equipment. This is an example of what it would look like. It's very straightforward, but it's an interesting concept. Okay, so looking at our budgeted balance sheet, as we said, we had a cash budget and capital expenditures budget on the balance sheet. We prepare it based off of operations and financial budgets from the master budget. It's dated at the end of the accounting period, and it's represented on a normal balance sheet where we estimate cash and expenses, capital expenditures. For manufacturing, we typically are only concerned about labor, staffing, budgeting. For non-manufacturing, we're concerned about labor and staffing as primary budgets. Non-manufacturing, as you know, are service-type businesses. For the most part, hotels are service businesses, as you know. So with a hotel, our largest concern with budgeting is usually based off of staff because it's a service business. With service businesses, we're mostly concerned about staff. So here's an example from the hotel.
What chapter is this?
This is 22, I believe.
Not all right.
It's the budgeting chapter, Drew. Whatever budgeting is.
Oh, yes.
Yep. Very good. Good question. Okay, so the hotel, this example, we have 150 guest rooms. We average 120 guest rooms per night during the week and 50 guest rooms per night on the weekend. My guess is this is probably a business hotel near the airport because airport hotels are usually very slow on weekends and very busy during the week. This is a business district hotel, right? Housekeeping staff is able to clean about 10 rooms per employee. So if we have an average of 120 guest rooms per night during the week and 50 on the weekend, each housekeeper can clean 10 rooms during a day, during one day. So 120 guest rooms per night divided by 10 rooms per day for the housekeeper, that means I need a total of 12 housekeepers per day during the week and 5 on the weekend. And And so you can see that this type of staff budget helps me to prepare for the number of staff I need to perform their duties during the weekend on the weekend. How much is it going to cost me though? So if I need 12 housekeepers during the weekday, they work an average of 8 hours per shift, and they work an average of 260 days in a year. That means the number of housekeeper hours per year is going to be 24,960. At $15 per hour, my budget for housekeeping during the weekdays is for the year is 374,400. On the weekends, we're looking at 62,400 for a total of 436,800 set aside for housekeeping for the year. Yeah, it's about right. It's about right. It's interesting, to say the least. That's how budgets are done for, staffing. It's pretty typical. Of course, you want to figure out what the occupancy rates are. Once you find out your occupancy rate, meaning room nights, average room nights per weekday, you can figure out what it is for the week. You can figure out what it's going to be, how many housekeepers you're going to need for each day, based off of how many rooms they can clean in a day, an 8-hour day, and then you can multiply that by their hourly rate to figure out what your budget is for each weekday. Yeah, it's interesting. It's fun. Of course, as we have, as I mentioned about having flexible budgets, if we have a wedding booked or we have an event booked, you're going to need an increase to your staffing for those respective events, which will of course increase your expense, but it's also based off of the revenue. Okay, that was budgeting. Any questions on budgeting? No questions on budgeting? Okay. I'll go ahead and stop this recording. Let's take a 10-minute break. Let's be back here by 12:30.